Welcome to Thoughts on the Market. I'm Devin McDermott, head of Morgan Stanley's North American Energy Research Team and the lead commodity strategist for global gas and LNG markets. Today, I'll be talking about some of the big debates around natural gas and shale in 2024. It's Thursday, January 11th at 10 a.m. in New York. The evolution of shale as a viable, low-cost energy resource has been one of the biggest structural changes in global oil and gas markets of the past few decades. In oil, this turned the U.S. into the world's largest producer, while falling costs also led to sharp deflation in prices and global oversupply. For U.S. natural gas, which is more regionally isolated, it allowed the market to double in size from 2010 to 2020, with demand growing rapidly across nearly every major end market. Over this period, the U.S. transitioned from a net importer of liquefied natural gas, or LNG, to one of the world's largest exporters. But despite this robust growth, prices actually declined 80% over the period as falling cost of U.S. shale and pipeline expansions unlocked low-cost supply. Now looking ahead, after a multi-year pause, the U.S. is set to begin another cycle of LNG expansion. This comes in response to some of the market shocks from the Russia-Ukraine conflict, including loss of Russian gas into Europe, as well as strong demand growth in Asia, where LNG serves as a key energy transition fuel. In total, projects that are currently under construction should nearly double U.S. LNG export capacity by the later part of this decade. While the last wave didn't drive prices higher, this time could be different, as it comes at a time when some investors feel peak shale might be on the horizon. Shale is maturing, well costs and break-evens are generally no longer falling, and pipe expansions have slowed significantly due to regulatory challenges. While many of these issues are more apparent on the oil side, there are challenges for gas as well. Notably, the lowest cost U.S. supply region, the Marcellus in Appalachia, is constrained by lack of infrastructure. As a result, meeting this demand likely elicits a call on supply growth from higher cost regions relative to last cycle. This not only includes the Haynesville, a gas play in Louisiana, but also the Eagle Ford in Texas and basins in Oklahoma, potentially requiring prices in the $4 to $5 per MMBTU range to incentivize sufficient investment. Investors are split on the natural gas outlook. Bears argue that abundant low-cost domestic supply will meet LNG demand without higher prices, just like last time, while bulls expect higher prices this time around. Now, strong supply and a mild start to winter heating season has actually pushed Henry Hub prices lower to close out 2023, bringing year-to-date declines to 50%. While this drives a softer setup for the first half of 2024, lower prices also come with a silver lining. They should help moderate potential investment in new supply ahead of the pending wave of LNG expansions. As a result, we believe the bearish near-term setup may prove bullish for the second half of 2024 and 2025, a dynamic many stocks in the sector do not fully reflect. Thanks for listening. If you enjoy the show, please leave us a review on Apple Podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.